could message me, let me know that you can see the screen okay and that you can hear me okay, so that make sure we avoid any technical difficulties. That would be very useful. But good morning, good afternoon to everyone. We're really happy that you could join us today. We do need to go over a few housekeeping things, so I'll introduce myself first. My name is Ellie. I work for Sales Tax and More, and I'll be running the poll questions today and helping Mike out with whatever he needs. So if you're here for a CPE credit, we're so happy to have you. You do have to do a few things to get that CPE credit. We'll need you to answer all our poll questions. I will so happily remind you every single time a poll question comes up, and you will not be sick of it at all. We'll also need you to fill out the survey at the end of the webinar. And you can do that one of two ways. It'll pop up right after you exit the webinar at the end, and you can fill it out then. If you don't get it then, in 24 hours, so tomorrow you'll receive an email with a link to the slides and a link to the webinar. And just to know as well, I will be linking the slides in the chat box as soon as we get going, along with a couple other really great handouts that Mike has put together for you. So a few more important things to note here. If you have questions, please ask us. We're going to either answer them as we go along or answer them at the end. And if we don't get to your question, don't worry, we will send you a follow-up email with the answers to those questions. And then again, a reminder here about the slides as well. So just a little bit about Sales Tax and More here. So Sales Tax and More, we are a full service consulting and solutions solutions firm. Our team is experienced tax professionals, and we're really dedicated to fulfilling any of your state tax related needs. So we do a lot of returns, registrations, consulting, research, and like our name states, more. So if you do have questions, please reach out to us about any of those things. And a little bit about Mike as well. So Mike has been one of the leading U.S. authorities when it comes to sales tax. So he works with he does a lot of e-commerce, Nexus. Whoa, I'm getting all mixed up here. I apologize. He's literally assisted thousands of sellers with their sales tax needs, foreign and domestic, who are dealing with U.S. state tax issues. So we work United States, Canada, Puerto Rico. He has a chance to be in a lot of outside press and webinars. And with that, I'll just turn the time over to you because I'm tripping all over myself, Mike, here. But and we can go ahead and get started.
Well, thank you, Ellie. That was a very nice introduction. We got a lot of exciting stuff to talk about today, and it's very understandable that we can sometimes get flustered with how quickly things are changing at this point. So I'm going to keep my camera on in the beginning of this presentation, but turn it off as we get into the meat and potatoes. We're going to go over a couple of things today. Number one, next this definition we're getting at the phenomenon about the newer trends that we are seeing, states moving away from transactions. That's a big trend we're currently seeing. We're going to talk about physical nexus, because a lot of companies out there that we're talking to haven't even realized that they have nexus for other reasons at this point, other than these economic nexus. We're going to talk about marketplace collection, and then here's the big one. We're going to talk about that new California special VTA. We're going to go into that, and then we're going to talk about what we believe the future holds and what to do if you do have nexus. So the worst time to find out that you have any of these problems is when a state is contacting you. Because, you know, if a state's contacting your client, their options are limited. If you are proactive, there are a number of different paths you can follow to decrease potential liability and exposure. But once you or your clients are contacted by the states, then those options are very much limited. So let's get to our first polling question. Ellie, can you take us through this? We want to see a little bit who we have in the audience.
Absolutely. I'm launching that poll right now. So basically, we want to know what your Nexus knowledge is like. So if you could take a second and fill this out. Again, if you're here for CPE credit, we do need you to fill out these poll questions. We'll give you guys about 5 or 10 more seconds to get those answers in. So make sure you do that. We're still having a lot of people click through Mike, so I just am going to keep it open here a few more seconds. But people are generally falling somewhere in the middle here. So we have a wide range, but most people know the basics or have intermediary knowledge. So a few more seconds here, and I'm going to close this out.
We have any Nexperts? Anyone who's going to keep me honest?
We do. We have a few Nexperts out there.
All right. Always like to see some Nexperts out there. That's a Nexus expert.
All right. Take it away, Mike.
All right. I'm going to turn off my camera at this point. And, for you Nexus experts, this will be very basic. But for some of our other participants, let's start off with a definition of Nexus. And it's just Nexus, just a fancy word that means link or connection. And it's the link or connection that must be present with a state before that state can require you to collect its taxes, like a sales tax or a seller's use tax, or pay its taxes, like an income tax, a franchise tax, or even a consumer use tax. And this link, used to have to be, for sales tax, some sort of physical component, but since we have Wayfarer last year, it no longer requires a physical component, just, some sort of threshold. So Nexus, it's just really a starting point, though, because if you don't have Nexus, this link or connection with a state, then you don't have any further responsibilities. No Nexus equals no problems and no responsibility. State can't require you to collect or pay its tax if you do not, or if your client does not have Nexus. If your client or you do have Nexus, then it's not the end of the world. You just have to, ask a couple more questions, like, is what you sell taxable? Maybe you're selling groceries, and in most states, not all states, but many states, groceries are not taxable. So you're not going to have a responsibility to collect tax in those states. Or maybe you only sell through a marketplace. And we're going to talk about this more later, but maybe the marketplace, it's a state where the marketplace needs to collect the tax. So you still have Nexus, you just don't have a responsibility to collect the tax anymore. So it all starts with Nexus, but even if you have Nexus, it's not the end of the world. You just got to ask a couple more questions, and perhaps you will need to get registered to collect tax. Let's quickly talk about a couple of court cases. We're not going to get them into too deeply. There's 3 cases here that, I think are important, very important, or actually 4 cases if we count Wayfarer. But National Geographic, this was a California case, and the takeaway here is that the taxable activity, and by the way, these are all U.S. Supreme Court cases, started in California. The taxable activity does not have to relate to the Nexus creating activity. So, this comes up in a lot of instances, but let's say, you're a wholesale seller. You got, reps out there, and that's your primary business, and, you've got Nexus everywhere because of these reps, but you don't really care because none of your sales are taxable. It's a wholesale business. All of a sudden, you start selling direct to the consumer, and, you set up your own website, and, unfortunately, what a lot of sellers don't realize is that the activities of those wholesale reps create Nexus for their retail business now. And, a lot of, the people we talk to say, well, Mike, that's not related to this. That's a whole different division. Well, so long as it's the same legal entity, the taxable activity does not have to relate to the Nexus creating activity. So in this instance, the wholesale reps, that's the Nexus creating activity, and the retail sales are the taxable activity. So very important concept there. Once you have nexus in a state, all sales into the state, no matter what channel, if they're taxable sales, you need to be collecting either the sales tax or a certificate in lieu of the sales tax. This happens, you know, people say, well, I'm only collecting on my Amazon sales. I'm not collecting on my eBay sales. No, unfortunately, once you have nexus in a state, the state wants you to be collecting on all channels. All right, so the next one is Tyler Pipe. And for non-e-commerce companies or traditional companies that also sell on e-commerce, this is a big one. And the takeaway from this case is that third parties, people who have no relationship to you whatsoever, who are establishing or maintaining a marketplace, can create nexus. So real big one, third parties, you know, people not even related to you. We're going to get into that a little bit more later on. And then this fourth one, complete auto transit. You know, a lot of sellers out there, especially Amazon sellers, they tell me, well, the states don't have any right to tax interstate commerce. Only Congress can decide who can do that. Well, unfortunately, you know, about 90 years ago, 80 years ago, that was a true statement. But back in the 1950s, all of that started to change. And it culminated in 1977. And what the U.S. Supreme Court said at that point is a state can tax interstate commerce as long as it meets a four-pronged test. And it's a pretty easy four-pronged test to meet. So I just want to talk about that so we don't have a lot of people out there saying, well, you know, states are not allowed to do this. It's pretty well established that they do have the right to do this. And then we've got South Dakota versus Wayfarer. And the takeaway here is that you do not need a physical presence in order to create this link or connection whereby a state can require you to collect its taxes. It overturned Quill, it overturned National Bellis Hess, and those were the states that mentioned physical presence. So it's like they never happened. And what that's done is pave the way for economic nexus. And with an economic nexus, no physical presence is required at all. It can be based on sales. It can be based on transactions. South Dakota, they're the ones who started this all out, and they thought it was fair, $100,000 or 200 transactions. And in a state like South Dakota, that's not too bad. And a state like California, that seems like an awfully low number. So what happened is that a lot of states went out there and mimicked South Dakota. And we're going to talk about the trends where states are coming back and being a little bit more fair. But South Dakota was $100,000 or 200 transactions. And although the U.S. Supreme Court did not come out and say, yeah, those are fair numbers, you know, not explicitly, you know, they sent it back down to the lower court. But in their conversations, they seemed to indicate that, you know, hey, this makes sense. But they wanted the lower court to rule on that. And the lower court, the case was settled and they didn't address this specifically. A lot of states, non-taxable sales are included. This is important. You know, a lot of people I've been talking to have said, well, yeah, we've got physical nexus, we got inventory in the state, or we've got people in the state, but we're not over the thresholds. So therefore, it doesn't matter. Well, this does not override any other type of nexus. If you've got physical nexus, you have nexus. It's another chance for a state to get a bite at the apple. But if you already have nexus there, this doesn't override that or invalidate it. And the last thing, you know, especially recently, this is not an internet issue. A lot of people out there are saying that, you know, this is an internet tax. It's not. It's a multi-state issue. If you have clients selling into multiple states, this could impact them. It doesn't matter if they're selling by telephone. It doesn't matter if they're selling by catalog. Anyone who's selling into multiple states that does not have a physical presence can be impacted by this. Internet, biggest issue, but it's not only an internet issue. It's truly a multi-state issue for all types of companies out there. As of now, there are only 3 states that don't have some sort of threshold. That's Florida, Kansas, and Missouri. Florida, they just drag their feet, and unless there's some sort of special session that the governor calls this year, it's going to have to wait till next year, but we strongly believe they're going to do it. Kansas, they keep vetoing it because they're tying it to a drop in the groceries. There is a tax on groceries in Kansas, and the governor says we can't lower taxes at all. So long as it's being tied to the tax cut, doesn't look like it's going to pass in Kansas. It's actually, I think it's been vetoed twice so far. And then Missouri tied theirs to credit card companies, and that didn't pass at this point. They're saying that all credit card companies have to collect the tax. So I do think that, this time next year, we'll see all states have some sort of economic nexus, but right now, these three, we do not see it. We do have a great free chart. Nellie will be getting a link out to you for this. We update this quite regularly. Every time a state makes a change, we go out and update this. If you can see the titles up there, it's the effective date, what date it took place, what the monetary threshold, what the transaction threshold is, if there is any, what the calculation methodology is. I mean, in some states, you look back at the prior 12 months. In other states, all you have to do is look at the previous calendar year. So every January, you need to check this. And then in some states, it's the previous calendar year or the current calendar year. So, this is a lot of times you may have to change in the middle of a year. What's included or excluded from the threshold calculation? And when states first pass these, a lot of times they don't give you a whole lot of information. Sometimes they do. In some states, all sales are included, even wholesale sales, even sales through a marketplace are included. But then you get a state like Arkansas and they say sales through a marketplace are excluded. So what's included in that calculation is very different state by state. And as these states update, we're updating this chart. So you'll see the date updated, lots of different dates out there. And this is a living, breathing, every week, sometimes more than once a week, this appears to be getting updated. And then a project we're working on now is registration required if no taxable sales. Our opinion is no, it doesn't, but a lot of our clients want actual answers from the states. So as we're getting the actual answers, we're updating that. So great tool if you're an accountant, great tool if you are actually an e-commerce seller or have any type of remote sales. All right, so here's the trend away from transactions. We mentioned that a number of states started out just like South Dakota, and they had these 200 transactions. Well, the ones in yellow are the ones that started out with transactions, and they eliminated them this year. That's on the first line. Now, Pennsylvania, I think we're going to add that to this list. We're just doing some additional checking at this point, but it looks like they're the latest state to have eliminated the transactions. Some states have no transaction thresholds at all. And those are the states on that second line there. The ones in yellow are the new states that have come out this year and said no transaction thresholds. The ones without yellow have never had any transaction thresholds. And then, some states have no standalone transactions. For example, Connecticut is, and 200 transactions. I believe it's $250,000 and 200 transactions. New York, $300,000 and 100 transactions. So no standalone. Doesn't matter if you have 100 transactions if you're not over the $250,000 or $300,000. So again, a trend away from transactions. As I mentioned, Pennsylvania is going to be joining this list, and that's good news. I mean, not everybody is saying you got to have 200 transactions. I mean, some of these states have said, that doesn't really sound that fair. We're going to eliminate that. $100,000 is enough for us, or in the case of California, it's now $500,000. When they first came out, they were $100,000 and 200 transactions, just like South Dakota. Now they're at $500,000. So this is a big trend that we're seeing. We expect to continue seeing it. Not in all states. Some states are going to keep that transaction. So you can't take that 200 transactions lightly. You got to look and you got to see if it's a state that has it or doesn't have it. All right, so here's something else. You know, a big thing with the Supreme Court is, you know, South Dakota said, hey, we're only going to enforce this prospectively. And the Supreme Court liked that because in theory, you know, states could go back all the way to the 1960s because when the Supreme Court, you know, overturned these cases, it's like they never happened before. So, you know, the original cases were wrong. That's what the Supreme Court is saying. We were wrong. It's not that we should have, you know, because the economy has changed, that we are changing this. We should never have mentioned physical presence in the first place. That's really what the Supreme Court is saying. But they're worried about the states trying to go back. So in order for the states to make the Supreme Court feel better and to make Congress feel better, they said, we're only going to do this from the effective date forward. Here's the problem with that. Some of these effective dates are getting old. Some of them are older than a year now. So, you know, this is something we can't procrastinate on. This is something we really want to go out and see if we are over the thresholds now. Some of the states are already getting pretty aggressive. If you do try to register now, a lot of times people come to us and say, hey, I just want to register going forward. Well, states like South Dakota and South Carolina and now Wyoming, they're asking a lot of tough questions. Now, of those three states, the toughest is South Dakota. And they're pretty much saying, if you can't, you know, prove to us that you did not have Nexus on November 1st of 2018, then that's the date that you have to use. And we want all of our back taxes plus penalty and interest. Utah, they implemented on January 1st of this year. They're at $100,000 or 200 transactions. And a number of our clients started getting calls, and our clients, you know, said, hey, we're already registered here. What's going on? So they asked us to call Utah on their behalf. And we called Utah, and Utah said, hey, this is a brand new program. We went out and we purchased a list. And this is a list of people that we think should be registered under our new economic thresholds. And we're calling every single person on this list. And, you know, here's the problem when states are doing that. We're going to talk about this a little bit more when we get to physical nexus. They're not just going to be asking about the economic thresholds. They're going to be talking about all types of nexus. So all of the states are getting really aggressive about economic nexus. They're going to catch even the, what I call old-fashioned nexus in this net that they're throwing out. And I think more and more states are going to be getting more and more aggressive. So again, don't let your clients get too far behind on this. Don't get too far behind on this yourselves. It's a relatively small problem right now that's only going to grow with time. It's not going away. Economic nexus, unfortunately, I believe is here to stay. So that's my opinion there. Don't let yourself or your clients get too far behind. Now, not every threshold is economic nexus. We have cookie nexus. We have click-through or affiliate nexus. And we have notice and reporting requirements. So what's different about these three types of nexus is they're not considered economic nexus. They're considered a type of physical presence. So cookie nexus, you know, is when you've got, you know, a company installing data packets on your computer, on in-state computers. And then they use those cookies for all sorts of information. Advertising is some of it. And, you know, the states of Massachusetts and Ohio have said, well, you know, that's a type of physical presence. And yes, we are going to pursue those companies. Now, Massachusetts has been most aggressive up until this point. I know they have some legislation pending that may change this, but as of right now, they're aggressively pursuing companies that are over $500,000 in 100 transactions. And the effective date there is 10/1 of 2017. I know quite a number of sellers who have just ignored them because they don't think that the states have any power. And unfortunately, the states have done estimated assessments and they've gone to enforcement. So people calling us up after the fact and saying, hey, you know, what do I do? Well, at this stage, you already have a judgment against you. Not much you can do. The time to act is when the state actually contacts you. Cookie Nexus is something to worry about. Clickthrough Nexus, this also is a type of physical presence, and this is when, you know, a company allows people to refer people to them through a link, or it doesn't have to be through a link. It's just most often through a link. So that's why they call it click-through. But anytime you're paying any type of fee or commission or any type of value for a closed sale, then that's generally going to be Nexus creating. And the basis of this, New York started this, and New York's theory was, hey, if one independent contractor can create Nexus in a state, well, how about a whole state full of people steering business to you and you paying commissions for that? So that's how this came about back in 2008. Right now, there are 20 some odd states that have followed the state of New York. This went all the way to the highest court in New York, who upheld it, and it was appealed to the U.S. Supreme Court, who refused to hear it. One thing I want to talk about here, pay-per-click advertising is not click-through Nexus. There's not a specific performance here. It's not based upon a closed sale. If this is based upon a closed sale, then it generally fits these guidelines. If it doesn't, if it's not based on a closed sale, then it generally doesn't fit these guidelines. And we're going to talk about this. That's one of the trends we're seeing where this is going away. Use tax notice and reporting requirements. It's generally a series of 3 or 4 notices depending on the state. And the notices have to say, hey, we're not collecting the tax, so you, Mr. Customer, you have to pay that tax directly to the state yourself. And then we have to turn over your information to the state at the end of the year. Well, that's horrible customer messaging. I mean, who wants to know that, their vendor or the person they're purchasing things from is going to turn them over to the state? So that was bad enough, but the penalties on this are absolutely outrageous. Minimum $20,000 penalties in some of these states. And, a lot of people say, well, that's, unconstitutional. Well, unfortunately, this spent 10 years in the courts. When it went to the Supreme Court the first time, U.S. Supreme Court, they said, hey, this is not a tax. So they sent it back to the lower court, who allowed the state to move forward. This was Colorado. Once Judge Gorsuch, this is before he was a U.S. Supreme Court justice, he allowed Colorado to move forward. It was appealed back to the Supreme Court, who refused to hear it at that time. So very low thresholds. Puerto Rico, no threshold. Oklahoma, Pennsylvania, and Washington, $10,000 thresholds. Rhode Island, 200 transaction thresholds. Here's the good news. Some of these states are doing away with it. Washington, as of July 1st, Rhode Island, as of July 1st, they've done away with these notice and reporting requirements. Pennsylvania, right now, it's no longer an option. We're checking to see if on the lower transactions, it's still a threshold. So we may be adding Pennsylvania to yellow, meaning it's no longer in effect. But you got to look out for Puerto Rico, and you got to look out for Oklahoma. As of now, we believe that these thresholds are still in place. There is a chart out there up on our website also for remote seller notice and reporting requirements. There's a lot of states on here, but either the penalties are real low or the thresholds are real high. Some of the states don't even have penalties. And if there's no penalty, to me, that's just a recommendation. It's not a requirement. If you're not going to penalize me for it, then I'm not going to do it. So this is a chart I would take a look at as of now. The states I'd worry about are Puerto Rico, Oklahoma, and perhaps Pennsylvania. We're going to update this chart very quickly. Okay, so developing trends. Some states are eliminating affiliate or click-through nexus as they implement economic nexus. So, you know, they don't want to have all of these different thresholds out there, so they're trying to make your life easier. But that's not all states. So if you have an affiliate program, this is something you need to check and see if the state that, in the states where you have affiliates, they are actually creating nexus for you. And then the notice and reporting requirements, you know, Washington, Rhode Island, you no longer have to worry about as of July 1st. But these other three, and I think we're going to remove Pennsylvania from that list very soon, but Oklahoma and Pennsylvania. All right, Ellie, let's go to the next poll question.
Yeah, absolutely. And here's your friendly reminder. If you're here for CPE credit, you do have to answer these poll questions. We obviously want everyone to answer, and you guys are doing a great job asking questions so far. Please keep those coming in. We want to make sure that you get the information you came here for. So true or false, you must have physical presence to create Nexus. And Mike, it looks like we'll give everybody a few more seconds here, but most people have selected false. So
and that is the correct answer.
It is. So a few more seconds, I'm going to close this out and we can move on. All right.
All right. So let's talk about physical presence now, because as I mentioned earlier, when the states are looking for economic nexus, they're going to stumble across all types of nexus. And, you know, for companies that, you know, have been selling for years, you know, and they're just started selling online or remotely, this third-party nexus, this is a killer. And, you know, every day I talk to someone else who tells me, I never realized that. And sometimes it's the CPAs. I didn't know that third parties could actually create nexus. And this stems out of the Tyler Pipe, which was an extension of Scripto back in the 1960s. And both times the Supreme Court came down on the side of the states. And while both of those cases were about solicitation, you know, that language out of Tyler Pipe, you know, helping to establish or maintain a market, that's really become umbrella language. And there are a lot of activities that fall underneath this umbrella. And some of them are listed, you know, on the page here. A shortcut that I use is if you have a subcontractor or an independent contractor and they are interacting with the public, there's a good chance that that is going to be nexus creating. If they're not interacting with the public, if they're doing some type of back office work, or say they're developing software for you, that's generally not going to be nexus creating if they're some type of third party, independent contractor or subcontractor. But you know, this is usually the biggest issue. And when companies figure this out, it's not just one state they have exposure in, but a lot of times they have independent contractors all across the country. So if you have clients using independent contractors, you got to start asking the questions, in what states are they and what are they doing for you? Or refer them to someone like us and we can help them figure out if they actually have exposure or not. But the questions need to start being asked before someone finds them. And it gets worse. It's not just where they live, where this can be found out, but also where they travel. So, and by the way, it's not just independent contractors when we talk about travel, it's including your employees. So if you're talking about an independent contractor, you know, they still have to be helping you to establish or maintain a marketplace when they travel. But employees, a lot of times it can be, you know, pretty much any reason whatsoever. States like, you know, Michigan, Arizona, there's a few exemptions, but by and large, if they're there greater than 48 hours over, you know, the course of 12 months, that's going to be nexus creating. All right, so for FBA sellers, here's a big one. And, you know, most FBA sellers, you know, or I shouldn't say most, but a lot of FBA sellers or their advisors want to argue that inventory creates physical presence, nexus in most states, but unfortunately, with the exception of New York, the states are on pretty firm ground here. Now, I'm not saying that you have to collect the tax. There's a good argument to be made that says, Amazon is, like a consignment store. But that doesn't change the argument that inventory creates physical presence in most states. It doesn't matter who moved your inventory. A lot of states say, do you own tangible personal property in this state? And it's kind of hard to argue that you don't own tangible personal property in the state. I mean, inventory is tangible personal property for the most part. So I just don't think that's an argument that anyone can win out there. There'll be people who have differing opinions from me, but I think the states are on very, very firm ground there. Related entities. A lot of times people say, well, we don't do it, but we have another company that does it. Well, if third parties can create Nexus for you, how easy is it for related entities? If you don't want them to create Nexus, you generally can't be selling similar products with similar names, and they can't be performing services for each other, and they got to be true third parties. I mean, everything has to be done on an arm's length basis. A lot of people tell me, everything is arm's length, and then they're doing journal entries, moving inventory back and forth. No, inventory needs to be purchased in a true arm's length transaction. So something that needs to be looked out for. And then where you have employees, locations, or here's a big one. A lot of people are saying this to me recently. Well, we have a virtual office, so we don't have a location anywhere. Well, you're somewhere. So most of the states take the position that where you live or operate your business from is Nexus creating. All right, here's along those lines, here's a big case study. And this is one of the reasons you got to look out for independent contractors. You generally pay your independent contractors with a 1099. And states routinely share information with the IRS, other states. But one of the things they do is they ask the IRS, who's received a 1099 in my state? Because they're looking for people who have potential nexus, who are utilizing independent contractors. And then they go back and look at who's issued that. Well, in this case, we had an Amazon seller, and he was an early adopter. He went out and he got registered everywhere that Amazon had a warehouse. This was like 5-6 years ago. So there were a lot less warehouses back there, but he said, I'm going to be rather safe than sorry. What he forgot to do is register in his home state. He claimed he had a virtual office. He claimed he had no location. Yet Amazon sent out the 1099 to his home address, and the state of Missouri came after him and actually audited him. And there wasn't much of a defense there. We did help him out. We did get a number of sales excluded, but not a great ending here. Here was a guy who was really trying, just didn't know that where he was actually located created a problem. All right, Ellie, let's go to the next polling question.
Yeah, absolutely. Launching that right now. We really just want to know what concerns you the most about Sales Tax Nexus. So there's a few options here. I'll give you guys a second to read through there and answer, but your friendly reminder that you're not sick of yet, that you do have to answer these questions if you're here for CPE credit. These questions are still rolling in pretty quick, Mike, so I'm going to leave this up probably 10-15 more seconds. A lot of people have concerns about third parties and economic nexus, and those really are the two places that seem to be people's pain points. So we're going to close this out and we can move on.
Okay, those are usually the items that most people pick. All right, so let's move on to marketplace facilitators. And Ellie, we need to update this slide because a marketplace facilitator is someone like an Amazon and eBay, someone that a third party can go and sell their goods and products on. What we need to update is this is now up to 33 states that have passed legislation requiring marketplaces to actually collect the tax. More states are going to be doing this. Again, I'm going to make a prediction. By this time next year, I think that all states, or the vast majority, 40 plus states, are going to have some sort of statutes out there requiring the marketplace facilitators to collect the tax. Now, not everybody is collecting the tax all at the same time. We actually have to change these slides also, Ellie, because this all changed on July 1st. But you can see here's 4 of the websites that we track, and they're not all on the same page. So you've got to see who's collecting and who's not collecting. Now, the chart that we have out there on the marketplace collection, and the reason why, you know, Amazon is usually pretty good about this, but the reason why Amazon's not at 33 is some of these aren't effective yet. For example, California is effective on October 1st. Texas effective on October 1st. Illinois effective on January 1st. So the effective dates haven't come in. So the states have passed the statutes, but the platforms haven't decided to start collecting yet because they don't have to. So here's another great chart. This, you know, tells you what date the effective date is. And it also, you know, tells you whether or not these 4 websites are collecting. It tells you, you know, if we deal with a lot of smaller, you know, marketplaces ourselves. So we have information up there for them and just some of the notes. So again, this is a great tool to see in which states, which of these bigger platforms are actually collecting in at this time. Now, it's not always a good thing when a marketplace, be careful of what you ask for. I know everybody wanted this, but here's the problems. Number one, Nexus is still created, and you need to collect tax for your other channels. Remember back to, you know, the National Geographic case. And states are still pursuing sellers for back tax plus penalty and interest. You know, in Washington, there are 2 taxes on the return, and Amazon is collecting the sales tax and remitting that, but they're not doing anything with the second tax, that business and occupation tax. So that's the way Washington is finding people right now. And when they go back, they're not stopping just for this business and occupation tax, which has relatively, you know, small numbers attached to it. They're going after all of the sales prior to when Amazon started collecting, which was January 1st of 2018. And they have a 39% interest. So when you are registered for the business and occupation tax, then generally Washington leaves you alone. But at some point, you know, the states have all of this information at their fingertips. Amazon has it. And in a lot of states, written right into their statutes, it says anytime we want, you know, the correct information, you got to turn it over to us. And when that starts happening, I think that we're going to start to see states come after a lot of sellers out there for income tax. I think that's going to be the next big battle for Amazon sellers, not tomorrow, but maybe a year, 18 months, 2 years down the road. That's going to be what everyone's complaining about at that time. All right, Ellie, let's go to our final polling question here.
Absolutely. So we really just want your opinion here on California. So again, just a reminder here that if you're here for CPE credit, you do have to answer these poll questions. This is the last one. And a reminder again that the evaluation will pop up automatically when you exit the webinar, but it'll also be delivered to you in 24 hours if you miss it. So Mike, answers are still rolling in pretty quickly here, but a lot of people are worried, a lot of people think amnesty going forward or that refunds should be granted. People are across the map here, but those are the 2 most common answers so far. So we'll give everyone a few more seconds and then we'll move on.
Okay. So what does the future hold? Well, I think we've got a real dichotomy happening here. I think that for people who are selling only on marketplaces, I think life is going to start getting pretty easy for you. A lot of good things are happening. 33 states as of now have passed rules that says the marketplace is going to have to cover it. The biggest problem I see out there for people selling on marketplaces is California. Those people have received a letter, which we'll get to that in a minute here. So it's getting a lot better. Things are getting a lot brighter for those of you who are only selling on marketplaces. But for those of you who are selling on your own websites in addition to marketplaces or only on your own websites, I think things are going to get increasingly uglier. States are going to be out there looking for economic nexus. They're already starting to do this, but you know, they're just getting started. They're all going to be making a big push, in my opinion. And states are going to make examples of companies. That's how they get people to comply. They want people to be talking about their bad experiences so other people step forward voluntarily and they don't have to spend their money tracking you down. All states, as we mentioned, will have economic nexus by this time next year. And I think that all states will have Amazon and the other marketplaces collecting. If not by this time next year, you know, there may be 2 or 3 states holdouts. By the end of the next year, I think that all marketplaces will be collecting in all states. So what should sellers do? Sellers should register whenever there is nexus, whenever you have that link or connection. What you sell is taxable and the exposure is material. Now we've got to add one thing in here. This is a 4th thing. When the exposure is material and you're the one actually responsible for remitting the tax. I mean, if you're a marketplace seller, don't worry about it. And if it's in a state where the marketplace is required to collect the tax and you're only selling on the marketplace. So 4 criteria there. Materiality, by the way, is my comment. It's not something that the states say. Most states believe you should register from dollar number 1. Tennessee is one of the few exceptions out there. But I say we got to use some common sense here. I mean, if it costs more to be compliant, let the state come and find you. I mean, you'll save money by letting them come and find you rather than doing what the state thinks that you should be doing. So materiality has got to be a factor in whenever we look at things. All right. So there are a couple of different ways to register. Number 1, you can register prospectively. That means that you just register on a going forward basis. You don't worry about any of the past exposure. You can register historically, which is the way that the states want you to do this if you have past exposure. Or you can register through a voluntary disclosure agreement, which is a special program to mitigate some of the past exposure. And as a reward for stepping forward voluntarily, states usually limit the look-back period to 3 or 4 years. The reason why this is important is because if the state finds you, they're going to go back all the way to the date that your nexus first started, at least in theory. In reality, states routinely go back 7, 8, or 10 years. And that's huge. And the first warehouse in California opened in October of 2012. So that's what, 7 and change? California is one of those states that goes back 8 years. So right now, they're going back 7 and change. Next year, they'll be going back 8 years if they find you. So the VTA, the normal VTA in California is 36 months. That's 3 years. You save, 5 years worth of back taxes, or, you only go back to the date that your nexus began. But they also allow you to waive penalty, and in a handful of states like Texas, they actually waive the interest also. So as a reward for stepping forward voluntarily, these states are going to reward you. Now here's a big problem in California. A VTA is generally not available if the state has previously contacted you. So all of those letters that California sent out saying, hey, we have some knowledge that you've got inventory in our state and that's Nexus creating, that automatically invalidated you from a VTA. And a VTA is a great tool, but it's like all tools, it's not great for all scenarios. States are also generally going to try to include income tax in a sales tax via VTA unless prohibited. There are some exceptions. For example, you can do a VDA in a state like California where you have to do a totally separate VDA for their franchise tax because it's handled by a different governmental entity. But these are just some basic facts about VDAs, and I want to touch on them because, you know, California recently came out with something, and, you know, everybody probably has read, you know, Fiona Ma, the California Treasurer's letter to the governor, and she's saying, hey, this isn't fair. You know, everyone, you know, should not have to pay this. We should waive all the penalties, waive all the interest, all the back taxes, because the CDTFA is a criminal organization. Now, it was a very political letter, mainly because Fiona Ma used to be the chairman of the Board of Equalization, which used to handle all of the sales tax in California, and most of these policies started under her tenure. The problem is, and no one's ever accused her, but her board was accused of influence peddling, and the board was dissolved, and she was, you know, no longer in charge of an entity that had any responsibilities for sales tax. So it sounds a lot like sour grapes to me, and unless she's had some great epiphany, but you can't blame this all on the CDTFA because her entity stopped it. Anyway, I digress. A lot of people were waiting for the governor to respond, and I think he has responded, and that's with this California relief for marketplace sellers. It's definitely not something that everyone was wishing for. It stops far short of that, but I think it's the best that we're going to get out of the governor. The legislature, you know, wrote this up. This is not from the CDTFA. This is from the California legislature, and the governor signed it. And what this basically does is allow a VDA-like program for people who receive the letter. Remember, you can't normally participate in a VDA. It's not an amnesty by any means. You still have to pay back taxes going back to April 1st of 2016. You still have to pay penalty going back to you still have to pay interest going back to April 1st of 2016. Penalty is waived. Now, if you only have a year's worth of exposure, not a great program for you. There are other programs that are better for you. You know, there are the 1032 programs, which are penalty abatement programs that we can help you with. There are historical registrations. You know, there's a lot of different types of programs, but if you got 5 or 6 years worth of exposure, you know, anything older than April 1st of 2016 gets eliminated with this. Now, here's the catch. You have 90 days to act. So you don't have a long time. If you don't, and by the way, some of that 90 days is already expired. If you don't respond within that time period, California is going to be coming for you. California is not going away. And when they come after you, it's not going to be limited to April 1st. They're going to be going back the 8 years. So a lot of people tell me, well, I'm just going to wait. All right, if you want to wait. But this is going to be, your theories are going to be tested very strongly because at some point later this year, California, I've had conversations with them already, they're going to be turning over companies to audit. And if you don't cooperate, they're just going to get estimated assessments. And if you're making up numbers, you know, why not make up a really high number? Those really high numbers, you know, generally get people to act. And at that point, a lot of times it can be too late already. So I suggest that if you have one of these letters from California, and here's all the language in here. When you get the slide deck, you can read all of this, but here's the summary. If you have one of these letters from California and you, the letter I'm talking about is them saying you need to register because you have inventory, and your exposure goes back, you know, to 2012, 13, 14, 15, this is your last chance. And, you know, if you want to take your chances with the state of California after this, I'm advising you very strongly that you don't, or you don't let your clients do this. States have a lot more power than anybody gives them credit for, and they will pursue you even if you're in other states. All right, let's open it up to questions. And does anyone have any questions, Ellie, about anything or California?
We do have a few questions here. Some of them are a little bit of a review. We ended up going over them, but we can touch quickly on them. So, so we'll start with this one. What if a business is not charging sales tax, but should have collected it from their customers?
I'm sorry, what's the question?
What if a business is not charging sales tax, but should have collected it from their customers?
That then becomes their responsibility. So in most states, it's the responsibility of the customer to pay the sales tax, but it's the responsibility of the seller to collect the sales tax. And if the seller refuses or didn't collect the sales tax, then that becomes the seller's obligation. And, you know, if they didn't do it for 3 or 4 years, the state will come after them for 3 or 4 years worth of back taxes.
Okay, great. A couple other questions here. Let's see. What is the easiest way to determine if a state has locality that requires separate filing from the state filing?
You're talking about local jurisdictions? I'm not quite sure about this. I'm assuming that this is with the local jurisdictions, which is generally in the home rule states. And there are 5 home rule states that people generally talk about. It's Alaska. There's no state level sales tax, but they do have local jurisdictions. Then you've got Arizona, Colorado, Alabama, and Louisiana. So these local jurisdictions in states like Alabama, Louisiana, and Arizona, they either have special programs or they've modified their programs so that there are no longer any separate returns that need to be done or any separate registrations that need to be done. That still is an issue in Colorado. And, you know, Colorado's a mess right now where, you know, you talk to 10 different people and you get 10 different answers. But, you know, the local jurisdictions in Colorado are saying if you have, a number of our clients have gotten letters and they're saying if you have Nexus in Colorado, then you have Nexus in our local jurisdiction and you need to register. Well, sometimes the amount of tax is like 80 cents. And again, we got to use some common sense. You know, materiality has to pay a factor. So right now, you know, if someone has a lot of sales, a lot of exposure in the local jurisdictions in Colorado, we're suggesting they do go ahead and get registered and filed there. In the other states, it's no longer an issue. You just have to do a special registration. If you only have Nexus in those states because of, you know, thresholds, then that's when you're allowed to use these special programs. You pay, you collect one rate for the entire state, you file one return, and they fix it, you know, internally in the state. But if you have Nexus for other reasons other than economic thresholds, then you got to go and see what the Nexus requirements are in each of these little jurisdictions.
All right, thank you, Mike. And there's so many questions are coming in right now. Again, just a reminder, if we don't get them to them live, we will email you afterwards. So let's go to a question about California. So what if Colorado registered after Wayfarer in California, not realizing they had inventory via the marketplace? Can they go back and utilize the new program in California?
It depends on when you got registered. So if you got registered after December 1st of 2018, then yes, you can go back and use the new program. If the state's not giving you any problems at this point, then some of our clients are not worrying about it, but you know, the state is allowing you, even though you're registered, even though you've been filing returns, if you registered after December 1st, to go ahead and take advantage of this program.
All right, thank you. So, and let's address this one too. So, the person says, maybe this is slightly off topic, but how should I account for back?
Actually, before we get into that one, there's another one that I want to cover here, Ellie. And it says, with the states moving away from transaction thresholds, does FBA inventory still make nexus in the states where the remote seller is below and no other physical nexus? And unfortunately, the answer to that is yes. Who's collecting the tax, or whether or not you're over a threshold, we talked about both of those things, doesn't change whether you have physical nexus or not. So, a lot of sellers have called us up and said, hey, I need to deregister. I said, why? They said, well, we're under the $500,000 threshold, and, we got registered because of this. I said, do you have inventory in California, in an Amazon warehouse? Well, yes. Well, the thresholds don't override that. The fact that they did away with the transactions don't override that. And the fact that Amazon's going to start collecting there will not override it. Nexus is Nexus. Now, you may not have to do anything else if you're just selling through a marketplace, but if you're selling on other platforms, through your own website, or over the telephone or however else, then yes, you still have Nexus in that state because of your inventory in an Amazon warehouse.
All right, thank you. Thank you for that, Mike. Okay, so let's move to this one that I was going to do before. So how should I?
Actually, we're out of time.
Oh,
so.
Okay. A reminder for everyone that if we didn't get to your questions, we will email you a follow-up. We had lots of great ones come in, and we really appreciate you guys reaching out to us, and we're really glad that you can make it join us today. So Mike, do you have anything else you want to add?
No, just that we'll get all of your questions answered. We've got another meeting coming up, though, so I've got to hop. I apologize for that. I thank everyone for coming today, and please give us feedback. Was this presentation helpful? How can we improve it? What other topics do you want to know about? And thank you for everyone for joining us.
Thank you, guys. Have a good one.
Bye-bye.